Are you a business owner looking to improve cash flow? Well, today I'm going to introduce you to the three C's. And these are the three ways, not only ways, but three primary ways that I have seen business owners save and improve cash flow, at least at the outset. And then what we do is go through some type of steps and we increase as we go forward. So let's start off. The first one is a CRA. Of course, taxes. And especially if you're a business owner and you just start working on your plan and you're looking at your financial situation, one of the first things we typically look at is your tax position. Look at ways to optimize your tax positions specifically that you could have a more tax efficient position. And sometimes we're able to look and see there are ways where you could save money because you've been overpaying, right? So that's more or less what we do. And the way we do that is we look at your last 2 to 3 years tax return and see how you've been filing, see how you've been documenting things, see if things that could be included, not included, or certain bigger things that you could be doing and you have not been doing. Another thing is structure. And where I typically see this is with professionals. A lot of professionals start off, their business is doing well, and it's grown quite significantly. And they are, on the verge of deciding, should I get incorporated or should I not? And what typically happens is they're sole proprietor. So everything that's coming in is treated as personal income. And as you can imagine, the taxes for that could be quite significant. If you're over $250,000, for example, in Ontario, you're looking at 53.53%. And in many instances, they don't need all that money, meaning a part of it could be held as retained earnings in the corporation. And so we speak with these business owners and we figure out if it makes sense. We look at the numbers, but definitely getting the right entity structure in place helps. The other one is income shifting, is what I kind of called it. And we look at how you're being paid. Is there salaries that you're receiving salary? Are you and your family members receiving salaries, especially if you're family owned? Should there be a mix between salaries and dividends? What's the best way to optimize? We talk about long-term financial plan in terms of the benefits of taking salary with RRSPs and CPP that I talked about in another video. You can check that out. And we also, if we have existing business owners, we also have to make sure that the structure is properly in place to make sure you have the best capital gains treatment. If not, you could be treated otherwise. And so there are certain instances where we look at the difference between salaries, dividends, capital gains, and see how it could be categorized. So, and a lot of times we're looking at this at a business level, but we're also looking at a personal level. And this is important because a lot of times what happens is people are just filing taxes. Sometimes they're even behind on filing taxes, not because they don't want to, because, there are certain things they need to provide information to their accountants or bookkeepers, and so they start to fall behind. But definitely optimize with the first C is with CRA. What's the next one is cost reduction. Now, some business run on no debt, and for those that are able to do that, that's amazing. Unfortunately, with a lot of businesses, unfortunately or fortunately, because sometimes having debt is a way for them to grow, you may have significant debts, you may have significant loans, and so what we talk about is negotiating better rates. We talk about refinancing and consolidating. We talk about restructuring obligations. We talk about creating different assets that we could leverage that will provide you with tax efficient growth and also cost efficient growth, right? And here's the thing, even small rate reductions can compound into significant savings over time, which frees up cash flow and allows for you to reinvest in the business and provide you with business growth and help you with operations, right? So the second one was costs. So the first one is CRA, next one is costs, reduce interest costs, and the last one is capital. And when we talk about capital, we talk about optimizing your investment portfolio. Now, when I say capital, it's two ways, right? So it could be investment within a corporation with certain assets. It could be ETFs, mutual funds, whatever you're investing in. Capital also is how you reinvest in the business. So for example, if you're investing in the business, one thing you could do is look at the line of products that you're providing and see if we have underperformers, right? So sometimes you have all these products, you have all this marketing, and sometimes there's an 80-20 rule. You have 20% of the products that bring 80% of the value. Maybe we double down on that. Now, if you're invested in the corporation, for example, in mutual funds or things like of that nature, then you look and see, is there something here that's underperforming? And there may be opportunities based on your risk tolerance to make changes to that. And, you know, a lot of times your opportunity may be to, you know, compare and switch and move it to low cost ETF or index funds or whatever other institutional products based on your situation. Another thing is we also have to consider tax advantage vehicles, corporate class. And I know we just talked about mutual funds, but corporate class has certain tax benefits that's often missed by individuals. And at an individual level, we also have to look at RSPs and TFSAs. And also we have IPPs, which can be used as great tools for especially professional, incorporated professionals. It's great tools that you could use for long-term pension planning, long-term retirement planning, right? So what we have here are the 3 C's. First one is CRA, then we look at costs, and then we also look at capital. And if you're stuck wondering where should you start, I would suggest kind of looking at things this way. CRA, see if you can save on taxes. And part of it also is you start now, but you also, the things that you incorporate now are things that you could implement going forward. The other one is cost, interest rate reduction, and you'll be strategic about your financing. The other one is capital, is where you're investing the retained earnings, whether it be back into the corporation itself, and the products and investments and even the people, or also you could look at, you know, external things that you're investing in. So whether it be mutual funds or other assets, real estate, etc. And if you do this thoroughly, and if you have not been doing this, what this ultimately leads to is potential for more cash flow, right? So those are 3 things. Hopefully that was helpful. At different points, I will go over each, but this is just a starting point if you're kind of figuring out, okay, how do I do this? I call it the 3 C's: CRA, cost, capital, and that ultimately leads to cash flow. Hopefully that was helpful. If you do find it helpful, like, share, subscribe. If you know somebody could benefit from this, feel free to share it with them. Take care. Till next time.